Hi there. This is Lee Thurburn, and you are on another episode of Live Stream Lee. I want to welcome you back. Today, we're going to be talking about a topic that is going to be very important to you in the near future. Now, it may already be important to you, but you may not just really know what to do. It may not be something that you've actually specifically thought about. I think you are like me, where you are noticing that prices are going up. We are now welcoming the return of inflation, and it is coming back with a vengeance. I know that you have been noticing the price increases in your personal, life. As you go to the grocery store, I got to tell you, everything is more expensive. Packaging sizes are getting smaller. There's a whole lot of things going on related to pricing that are not good. And unfortunately, as business owners, we can't just look at it purely from the perspective of a consumer, because as businesses that sell things to other businesses or to consumers, we're in a pinch. Our prices are going up, and unless we raise our fees or the prices that we charge, our costs are going up. Our margins are shrinking. And as a result, we're in a pinch. So I thought it would be good to talk about different strategies about how you can manage that pinch, how you can increase your prices during a period of high inflation. Now, I thought it would be illustrative to look at a chart, which I'm going to do in just a second, but I want to start off by talking briefly about two guys that help support this program, and you should know. The first is a guy named Bob Hampton. Bob is a financial advisor. He's also a CPA, and he has been helping business owners for the last 25 or 30 years do a number of things. One is, of course, prepare for their financial future, but importantly, also to prepare for the day when they're ready to sell their business. I know if you're like me, one of the reasons that you got into business is so that you could have an asset that you could sell at some point, would help with your retirement. And that is exactly what Bob does. Bob is an expert at business exit financial planning. And business exit financial planning is a specialized area of financial planning where you want to maximize the amount of cash you take out of your business and minimize the taxes that you pay on the cash you take out at the point in time you exit. And that's what Bob helps you do. So go to livestreamlee.com and click on the Bob Hampton link, the Impart Financial link, and get signed up with Bob's newsletter. Give Bob a call. He's a great guy. You're going to love talking with him. And if you don't have a specialist in your corner and your business is getting towards that point in time when you're going to want to exit, you need to talk to Bob now. The sooner, the better. The other guy I want to tell you about is one of the most fun people I know. He's a great storyteller. I'm a big history buff. I love looking at reading information about history. I feel like I'm a bit of a history aficionado, watching historical trends in our current life unfolding. And one of the things I really like about Dan Nelson is he is a storyteller par excellence. Dan sends out a newsletter every 2 weeks on Saturday morning that I look forward to getting, and I think you might too if you enjoy history. Dan is a genealogist, and in the process of researching stuff related to his clients' genealogical needs and wishes, the research that he does, he comes across a lot of interesting historical tidbits and facts, and he shares that in his Saturday newsletters every other Saturday. And I just find them really interesting. And if you're a history buff like I am, I think you'll find them interesting too. Go to livestreamlee.com and click on the Dan Nelson link. Sign up for Dan's newsletter. You're going to get some great stuff. It'll make interesting conversation around the dinner table or when you go to a party. just little historical tidbits, but really interesting stuff. And if by chance you are interested in getting your genealogy researched, Dan's your guy. I'm just going to tell you right now, he's good at what he does. So there you go. There's a couple of people that I think you would be glad you met. Now, to start off our conversation on inflation, I'm going to share a slide with you. This is a slide from Wikipedia or Wikimedia. I think it's Wikimedia. Anyway, it is a quick overview of inflation for the last almost 100 years here in the United States. And you can see some major peaks and some major valleys. Certainly back around World War I, 1914 through 20 kind of time frame, we had major inflation followed by deflation, and then in the run up to the Great Depression, we had major swings in inflation and deflation, and then of course in World War II time frame we had, and this is what you're looking at here. You had you had a lot of inflation, and then since that point in time, we actually had very low inflation in the 50s and the 60s, and then with the advent of the Vietnam War and then the Carter presidency, basically those two things kind of back to back just really screwed up our economy. And then when President Reagan came in, he kind of got things squared away. And we've had a period of relatively stable inflation under 5% for the better part of the last 30 years. Now, in the last decade, it's been even lower. And that is primarily because of a very active Federal Reserve trying to stimulate the economy while capping inflation. And this chart really doesn't show anything related to 2020 and 2021, where you had tremendous economic stimulus inserted into the economy. So it doesn't show what is going on now. Now, while that's interesting, I think you're going to find the next thing also very interesting. First of all, let me get rid of let me share the screen, and I need to, here we go, share screen, get my window up. Here we go, share. And I need to take that graphic off. Here we go. Okay, so what you see on screen now is, and I've got some, I think, interesting things to share with you. So first of all, we're going to start with what the current inflation is and the average inflation. For the better part of the last 100 years, inflation has averaged about 3.23%. In the last 10 years, it's really averaged a little closer to about 1.25%, 1.5%, maybe 2%. Right now, the most recent records readings of inflation tell you that inflation is currently running in the 8 to 10% range. But the federal government plays with those numbers because the current administration, and this is true of all administrations, they don't want you to have to, they don't want you to be afraid of what is coming down the pike. This current administration is clueless as to what is about to happen. Right now, inflation almost certainly is running at an annualized rate in excess of 10%. The likely inflation rate that'll be seen and reported on a regular basis in 2022 is going to be in excess of 10%. It could be in the 15 to 20% range, which is going to rival historical highs over the last 100 years. And the reason is really very simple, because we have pumped so many trillions of dollars into the economy. Now, I don't really care whether you are for or against. It's hard to not know that when you pump 3 times as much money into the economy within a 2-year time frame as normally would flow into the economy, you're going to see an impact. And Inevitably, that impact is going to be increasing costs. So we're going to be entering a period of not just return to normal inflation, but accelerated inflation, maybe even what could be called hyperinflation. Now, I'm not going to get into the definitions of the different levels of normal inflation and accelerated inflation and hyperinflation and all that kind of stuff. But what I do want to do is I want to talk about what this means when it comes to your business and your profitability and your margins. Anytime your costs start increasing at a rapid rate, um, you're going to have to respond to that. And as business owners, there are really a limited number of sort of inflation strategies that we can employ to help us get through these periods of rapid increasing costs. Now, the first thing is to realize that if you're a business owner and you have a clientele, you almost certainly have a clientele because you perform a service or sell a product that a customer or customers appreciate, and they don't want you to go out of business. People understand. Now, first of all, you probably have a relationship with your customers and they like you, which is why they choose to do business with you. And they know that you have to make a profit. And if you communicate to them what's going on, I mean, certainly they're seeing costs all around them going up. And when they see costs going up, they know your costs are going up. And if you explain to them what the impact on your business is and why you have to raise prices, chances are pretty good that they're going to understand and they're going to continue to do business with you because they don't want you to go out of business. If they like you and they trust you and you provide a good quality service, they want you to stay in business. And they know that even if they were to go shop for alternatives, chances are they're not going to get a better price, but they also then run the risk of not having the kind of relationship that you've already developed with your customers. So your first strategy is very simple to explain to your customers. That's the best thing to start with. Now, the next thing is always be focused on value. Be sure and talk about the value that you bring to the equation, bring to the table. I think of this as dialing up the microphone or the megaphone, turning the volume up, getting out in front of your clients and customers more frequently with value-related messaging so that they understand the value that the products and services that you have bring to the table. It's always a good idea to focus on value, but it's never a more important time to do so than when your costs are going up and you're having to raise your prices. Now, the next thing is to consider a variety of different sort of strategies about how you raise prices. Incremental price increases are certainly one way to do it. This is a strategy that has been employed by landlords and utility companies for, well, just as long as there have been landlords and utility companies. Landlords will almost every single time your lease comes up for renewal, raise the price. About 10 or 12 years ago, I downsized. And while I was in the process of downsizing, I had a long stretch of time where I had storage units. And at one point, I had 3 storage units that were about 20 foot long, 25 foot long by 10 or 12 foot wide. So they're pretty good sized storage units. I had a lot of junk. And when I started out about 12 years ago, the cost of the storage units were about $110, $120 a month. Now, 3 times 110 is obviously $330 a month. Not insignificant, but still, I just didn't want to get rid of my junk. I didn't have room for it because I had downsized my living arrangements. Well, over a period of time, every year, sometimes more frequently, the storage units would increase the prices by about $5 a month. And so At the end of 1 year, my price went from $330 to about $345, $15 increase, $5 per unit. And then it went up another $5. So the next year it was about $360. And then there was 1 year where it started a $10 jump every time I renewed. So it would go from about 360 to 390. Honestly, after about 5 or 6 years, my average storage unit cost was approaching $200. So of course it became quite painful, and I would think about all the money that I've spent on storage units. And I was, of course, starting to realize that I would have been way better off just to sell all my junk and get all new junk if I needed it or wanted it. But paying $1,500, $2,000 a year for storage per unit certainly started to add up. Well, the point is that when you gradually and incrementally increase your prices, your clients will have a tendency to forego or postpone the trauma of having to make transfer arrangements. And so, people like to continue to do their comfort in a zone is an important thing to realize. And so if you have the ability to just simply incrementally, gradually increase prices, that is certainly one great way to do it. Now, it could be that your chicken fingers go from $1.25 per finger to $1.29 or to $1.30 or to $1.35 or something like that. 10 cents extra per chicken finger doesn't sound like a whole lot. But of course, to you, that's 10 extra cents to cover costs per unit. So gradual incremental price increases is certainly a strategy that makes sense. Another strategy is what I think of as segmentation, surcharges. A variety of different businesses use this. The telecommunications industry, phone companies have surcharges, airlines have surcharges, online sales companies will often, if you buy movie tickets through Fandango, there's a handling charge, a surcharge. This is one way to adjust your surcharges and or to add surcharges. This certainly is a way to gradually increase your prices. Another thing that you can do is really on the cost management side, and this is to lock in your prices for an extended period of time by doing a futures contract. Now, this is something that you can do if you have a major expense category that's in a commodity market segment. I think most famously of Southwest Airlines back when I think it was like 2009, 2010. Southwest Airlines foresaw the probability that fuel oil prices would go up. And so they did a 3-year forward contract on all their jet fuel. And as it turned out, they happened to do that right before a major hurricane went through the Gulf, knocked out some refineries. And for a period of time, you may remember this, here in North Texas, gasoline hit almost $4 a gallon. In fact, I did see a couple of places where it was over $4 a gallon briefly here in the Dallas area. Well, if gasoline is that, jet fuel is probably $7 or $10 a gallon, and that's a tremendous expense that airlines have to cover. Southwest had been blessed to, right prior to the hurricane, a few months before the hurricane came through, they entered into a forward contract on locking in their jet fuel prices. And the profitability, because they locked the prices in at a low rate, the profitability that this brought to their airline allowed Southwest Airlines to make so much money over the course of the next year or so that they were able to accelerate their gate purchase program and their national footprint or expansion footprint much faster than they otherwise would have, because they were so cash rich by virtue of the fact that they had locked in their prices. Another thing that you could do is you could consider making some sort of a variable price on an aspect that's a critically important aspect of your house. Recently, A lot of builders have begun basically building into their contract to build a home a variable price, an allowance for lumber. In other words, they'll give you, let's say you're buying a home that's going to cost, I'll just put a number, 250,000. And maybe of that 250,000 specifically for lumber, there might be an allowance for say $50,000 for lumber for a certain number of board feet of lumber. Well, if your lumber costs go up because there's a shortage for whatever reason in lumber, your allowance when it comes to the house will be exceeded and you'll have to kick in extra money. So this is one way. Another way companies routinely do this is with healthcare allowances. Rather than give you free healthcare, they give you an allowance, and then they go out and negotiate with a carrier, and they cover a portion of your healthcare costs, and then you have to cover the rest. This is a great way for the company to be able to lock in their benefit cost and have you participate in any incremental increases in the cost of health insurance by your election to continue. Another way is what I call obfuscating, which basically is just confusing the market through bundling. When you bundle, you put different products or services or products and services together into bundles and make it seem like a good deal. Now, honestly, this is one of the things that, Happy Meals and Big Mac meals and things like that have been for a long time. This is McDonald's bundling burgers, fries, and a soft drink together to make it seem like you're getting a really great deal. Well, if you were to purchase the burgers, the fries, and the soft drink individually, it'll be a little bit more than what you get, what you pay for a bundled meal. But the fact is that a lot of people, if you unbundle it and they just buy the burger, they'll just buy the burger and get a drink of water, and they won't buy a Coke. But if you bundle things and make it seem like they're getting a little bit of a deal, they'll go ahead and take the bundle. And when they do, the most profitable component in the mix, which is the beverage, is purchased, and McDonald's increases their profitability tremendously over what they would if people didn't buy beverages. So bundling is a way to confuse the public. Another way to sort of slip in a hidden price increase is what's called shrinkflation. There's a couple of great examples of shrinkflation. One is in the food care or the food industry, and that is related to portion sizes. So one of the ways companies that sell food control their costs is to manage the size of the portion. So a filet mignon, which has sort of historically, traditionally been in the 6 to 8 ounce range, you're beginning to see filet mignons in the 6, 5, and 4 ounce range. Now, they don't necessarily lower the price, they just lower the portion because it keeps their food costs lower and allows them to keep the price the same, but lowering their food costs. You also see this with cereal packaging and, packaged goods in groceries a lot. They will, I'm thinking in particular of coffee. It used to be, 20, 30, 40 years ago that coffee, beans, and grounds would come in 1 pound containers. But with the rising costs of coffee, the packaging companies, the roasters and the packaging companies realized that one way to keep the price of a bag of coffee down was to simply put less in it. And so you initially saw 14 ounce and now 12 ounce and now 10 ounce. And I'm even seeing 8 ounce bags of coffee, both grinds and beans. The bags themselves have a lot of air, so they still look like you're getting a lot. But the reality is inside the bag, the amount of content is going down. And that's one way to control your food costs or to control your material costs in your packaging is through what's known in the industry as shrinkflation. Another way to increase your revenue is to diversify. Basically, just add new products to your mix, expand your business into new products. Now, there's a number of potential benefits from this. One is hopefully you already have an installed customer base, and by diversifying into new products and new services, you can do one of the age-old things that all businesses want to do, which is sell more to their existing customers. So if you have more things to sell and you already have customers coming through your doors, you're going to sell more. So by diversifying your product and or service line, you can increase your revenue, and often you can increase your margins, especially if you at the same time bundle some of these new diversified products, bundle them in with the existing product mix that you have. Another good way to be able to increase your margins is always just basically increased efficiency. That's always a good idea. Now, increased efficiency can come through a couple of primary ways. One is to lower your costs, and lowering your costs kind of boils down to a number of different strategies. One thing that you can do to lower your costs is to eliminate freebies and coupons. If you're in a business that competes with freebies and sales and coupons, you can consider reducing or eliminating the number or the volume of the freebie, of the coupon, and that sort of thing. Another is to simply use less costly inputs. Now, this, of course, can have the impact of lowering your quality and having a negative sort of implication to your future reputation, your brand, and your customer flow. But if you can lower your input costs without affecting your quality, that might be an option. But that's part of something you should always be doing, not just doing during inflationary times. Another thing is back to diversifying. You can launch new products. And the main benefit of launching new products is to lower the amount of overhead that any individual product has to absorb. So one of the benefits of diversifying and adding new products is you spread your overhead costs, your fixed costs over a broader range of products, thereby reducing the burden that each product has to carry of overhead, and then again, therefore increasing your margins. Another thing that you can do, also always a good idea, is to figure out ways to increase your volume. Now, there's really basically two main strategies to increasing your volume. One is increase your advertising spend, your marketing spend, so that you get your product and or message in front of a greater number of people. And the other is simply to open new markets or to take new products into new markets that you haven't been into before. There's always a concurrent cost with opening new markets, and usually there's a lag time between the opening initiative and the benefit of opening the market that begins to accumulate and build. The momentum builds over time. So you could end up having a short-term negative cash flow impact as a result of opening a new market. This is something, of course, that you just have to analyze on a basically market by market, opportunity by opportunity basis. Finally, we get to shrinking profit margins. One strategy, and this is not a strategy you can live with very long, but it is often the go-to strategy that businesses will just turn to, which is reluctance to increase their prices, which means basically that they're absorbing greater costs, their margins are shrinking, their profit margins are shrinking. You can only do that so long before you either go out of business or you just simply have to increase your prices. And finally, there's the Nike way of doing things. Just do it. Don't worry, sort of damn the torpedoes full speed ahead. I'm going to increase my prices because I have to. Now, if you don't do one of the things above and you reach point number 11 where you've absorbed all you can with shrinking margins, at some point you're just going to have to go ahead and raise your prices and accept what the ramifications are. It certainly makes a lot of sense to analyze in advance the various strategy options that are available to you and select the one or ones that fit best with your combination of clientele and mentality, market mentality, and the competition that you have, the resources that you have. I mean, you look at all these things and pick one that makes the most sense for you. If you have any questions or need any help with any of these kinds of things, please give me a call. Let me know. Go to apricotrocket.com, or I would like to invite you to also consider simply calling me, and you can find my phone number in a variety of places, one of which is at americanpatriotbusinesslist.com. You can shorten that to apblist.com. I'd like to just mention that one of the things I do to try to help businesses grow is I provide a suite of technology services, including a business list designed specifically for companies that are patriotic to America, that believe in America's founding values of, among other things, low taxes, low government or minimal government interaction and interference, and the Constitution and the Bill of Rights and those kind of things. If you are a business that is looking for more traffic, I would like to invite you to go to apblist.com or appyrocket.com. You can find my phone number there. Give me a call if you have questions about pricing strategies. I'll be glad to visit with you. Or just join, create an account. It's very affordable. And I promote the APB list, the American Patriot Business List, to people that are wanting to do business with companies that are founded by and managed by patriots, American patriots that are not afraid to stand up for the fact that our country is a gift to the world, a God-given just benefit to the world, and that America is the beacon of hope and liberty, and not be ashamed or afraid of standing for that. Okay, so thank you for tuning in. Come back on Wednesday when I will have another one of these. I'm going to be talking about China, the threat. I think we're headed towards a conflict, a war with China, and I'm going to lay out in detail on Wednesday why and when I think that's going to happen. So come back Wednesday at 3 o'clock for another live stream, Lee, and let's talk about how you can prepare your business for an uncertain future. Thank you for tuning in. I'll see you